Hi, this is Kevin from Excel Coaching. Welcome to this recording where we will explain the concept of solvency and liquidity. The ongoing impact of the COVID-19 pandemic continues to cause a significant deterioration in economic conditions for many companies. Accounting standards IAS 1 explicitly states that at each reporting period, management is required to assess the entity's ability to continue as a going concern. When management becomes aware of material uncertainties related to events or conditions that may cast significant doubt on the company's ability to continue as a going concern, those uncertainties must be disclosed in the financial statements. Going concern is a fundamental assumption in accounting and the basis on which financial statements are prepared. It works on the premise that a business will continue to operate in the foreseeable future without being wound up or significantly reducing its activities. Directors have a responsibility to assess both solvency and going concern. Determining solvency is separate to assessing going concern, and while rare, it is possible that the outcome of these assessments will be different. Often the terms solvency and liquidity are incorrectly used. Solvency. Solvency measures the ability of a company to pay its debts as and when they become due and payable. What is really important when it comes to solvency is that the debt or financial obligation to be included are both long-term and short-term. That is, both long-term and short-term debts are included in the assessment for solvency. For example, if your total debt, that is short-term and long-term, is $5 million, your total assets are $3 million, your total debt exceeds your total assets. And this could signal a solvency issue. While solvency ratio includes financial obligations in both the long and short term, liquidity refers to the ability of a company to pay off its short-term debts. Here, we are focusing on current assets and current liabilities. Current ratio is calculated as current assets divided by current liabilities. Current assets and current liabilities are both disclosed on the balance sheet of a company. Using this example, the current ratio is 1.89. So you've got current assets of 23.3 and current liabilities of 12.3. So your current ratio is basically 23.3 divided by 12.3, which gives you 1.89. How do you interpret the current ratio? The current ratio of 1.89 means the company has 1.8 times more current assets than current liabilities. It is a healthy position to be able to cover your short-term debts. Usually, a current ratio of around 1.5 to 2 is considered okay. A much smaller current ratio may show liquidity weaknesses. If the ratio is excessively high, this could also be a problem and may suggest that cash and cash equivalents are not being used efficiently. For example, if a company has an excessive inventory, it will show a high current ratio. Other ratios like quick ratio can also be used for liquidity. Quick ratio is essentially current assets less inventory divided by current liabilities. So the difference between quick ratio and current ratio is basically how we treat inventory. Thank you for watching this recording. Our objective was to explain the different terminology around going concern, solvency, and liquidity. We trust you have found it useful. If you like our recordings, please do subscribe to our channel. There's a subscribe button underneath the recording or by clicking on the Excel Coaching logo. Thank you, and until next time.